real-world assets on-chain. It's one of the biggest bets in crypto right now. But there are two problems: getting assets on-chain and getting them to the investors who actually want to buy them. Most of the industry is focused on the first. Almost nobody has cracked the second. Richard Brown, CEO of R3, has spent a decade on both. Today, he breaks down why distribution is the real game, why hundreds of billions in stablecoins have nowhere good to go, and why the financial system has to come to on-chain investors, not the other way around. This is Unblocked with Dr. Gemma Green.
Richard, it's great to have you on Unblocked. Thanks so much for joining us.
Thanks, Gemma. Great to be here.
Most people in the blockchain space will have heard of the name R3 or Corda, but maybe they don't know exactly what these organizations do. Could you start by just explaining them for us?
Yeah, so maybe if I tell you what we're doing now, I might even challenge myself to do it in one sentence. But then what I say might surprise people because it may seem on the surface somewhat different to what we were doing 2, 5, or even 10 years ago. So when people ask me what we at R3 do now, I say for me it's pretty simple and straightforward. We're packaging off-chain yield for on-chain investors. Now, that's a very small, short sentence, but packed inside that is a lot of information and a lot of implications and assumptions. So, first thing is when I say we're packaging off-chain yield, there's a big bet we're making or a big observation, which is there is a large amount. There are large numbers of real-world assets, whether they're bonds or investment funds or whatever they are that exist off-chain that represent real economic activity. And right now, a vanishingly small amount of that is available to people, individuals, institutions, or whatever it is, who do their business on chain, so on permissionless blockchains. For them, mostly what they can invest in is regular tokens, Bitcoin, Ethereum, or whatever it is, or maybe stable coins. But there's a very, very small amount. There's a very limited ability for those investors to actually get exposure to cash flows and assets that exist in the real world. And I guess if I talk about our history in a moment, we've spent a lot of time trying to bridge those two worlds. We're from traditional backgrounds, but we're now firmly of the view that on-chain markets, these permissionless blockchains, are here to stay. And so, if I then restate what we're doing, which is to package off-chain yield for on-chain investors, hopefully that becomes clear then, which is to say it's our job to help identify these assets that exist off-chain, bring them on-chain in a form that is accessible to, interesting to, and exciting to those who are on-chain, so that they can actually invest in it, and then whilst remaining on-chain with all the benefits they get from that, they get exposure to stuff that's happening in the real world. So that's what we're doing now. That's the new R3, if you like.
You definitely succeeded in explaining it in a sentence, and then thanks for also unpacking it. Maybe I could just sort of press on some of the things that you said. Why would it be important for people to own traditional financial assets like stocks and bonds using crypto? Why can't they just go on the NASDAQ and buy a share? What's the difference for them? Why is it appealing? What does that provide?
So it's a really, really fair challenge. There is a bet at the heart of this, which is, and I guess it's a belief. So ultimately it's empirical and can be challenged and tested. But there's a bet that the small but large, the small but quickly growing pool of investors who are on chain will want to remain so. And what do I mean by that, and why do I believe it? So. If you once spent any time actually really interacting with these decentralized finance systems, at first it seems a bit sort of scary and confusing. You've got your crypto wallet. There's always the worry: are you going to get hacked? Are you going to lose your keys or whatever? But you get past that, and of course there are lots of solutions to that. You get past that, and suddenly it becomes apparent, which makes you think, hold on a sec, this is in many ways better. So in a single place, whether it's my own wallet or a custodial wallet somewhere, in a single place, I can hold all assets, whether it's a cash equivalent, such as a stable coin, whether it's a token, whether it's something that yields, whether it's a bond, whatever it is. I can hold it all in one place. And these things are, they're interoperable and composable. There's like, there are lending markets I can go to where if I've got an asset, I can borrow against it. So I still own the asset, but I can get hold of cash, which I can then use somewhere else. It's not fragmented. It's not gate kept in an unnecessary way. Everything is, certainly on platforms like Solana, where we're focused, everything's in one place. It's accessible to a large number of people, and it kind of just feels more modern. It's almost like how you would have built the capital markets if the technology had allowed it at the time. So there's that observation, if you like, and then you look at what's happening. So the value of all the crypto assets is in the trillions. The value of the stable coins on these networks is in the hundreds of billions and rapidly growing. And so the question is, you've got these people on chain either who brought money on or who have made money on chain, and who are they're saying, well, how can I diversify? How can I actually have a good exposure to a good range of assets? And the question they face then is, okay, well, if those assets aren't available on chain, either I don't invest in them or I've got to take my money off chain. And if you put yourself in their shoes, you think, well, why would I want to do that? I'm the customer. Customer is king. I'm the customer. I've got the money. I don't want to have to interact with what I, in that case, see as the legacy system. I want the assets to come to me. I am a source of demand, and I would like exposure to whether it's private equity, private credit, commodities, whatever it is. If you can bring them in the right form that's consumable, it's liquid, it's accessible, I will buy it. And so it's a belief about the market. It's a belief that this will grow, and that there genuinely are people, individuals, institutions who want access to more than just just like crypto kitties or whatever it is. They actually want real world assets to invest in, and they don't see why they should have to go to the legacy financial systems. The financial system should come to them. So that's to be like it's the bet we're making. We could be wrong, but that's what we've come to believe.
Thanks for explaining that very clearly. So far, how do you feel about your bet? Like I've seen some of your press statements. You've got tens of billions of dollars of assets on the platform. How is it going in terms of the kind of thesis that you formed and the tech that you built to respond to that?
If I talk about the you mentioned the tens of billions, so if I start there, that really talks to how we got here. So the business we built over the last 10 years. So before we moved wholeheartedly into this space, with R3, I as CTO as I was then, we built a platform called Corda, the Corda blockchain, which is a private permission blockchain that financial institutions can use amongst themselves to optimize how their markets work. So for example, the Italian banking system uses it to synchronize all the banks and reconcile every night. The Swiss stock exchange, six digital exchanges built on Corda. It's been a pretty successful business, but the private and across those networks are issued $10 to $20 billion worth of assets, depending on how you measure them. But there is a natural limit to how big that market and that business can become, because these networks are inherently private and permissioned. They're isolated from each other for good security and perhaps regulatory reasons. But those assets, huge amounts of work has been done to digitize some traditional assets and get them on these networks, and yet there's no additional form of demand, because it's the same asset issuers selling them to the same investors. And so the realization we had a year or so ago was, okay, we've done all that, but the real demand, the party is on these permissionless chains. That's where the growth is. That's where the new demand is. And so we need to connect to these worlds. So we did two things, and I think both of them are going well. So the first one is we needed to build technology to allow our existing networks to connect, so that these assets that have been issued, as and when it's appropriate and regulations afford, those assets can flow. And actually, we've just, hot off the press, in the last few weeks, we've just shipped Corda 4.14, which is the version of Corda that allows that connectivity to happen. So now, our teams are going out to all our customers saying, guys, good news. These private networks you built that look kind of like, isolated and disparate, you can now directly take these assets as and when there's demand, and you can bridge them across. So that's part one, and I'm really proud of the team for getting that over the line ahead of schedule, which I think is probably the first time we've ever shipped something at R3 that was ahead of schedule. And then the second part is that we know that that's necessary, but it's not sufficient. The assets on the existing Corda networks are such a tiny percentage of the world's real world assets. We can't only do that, so we have to go direct as well. So we're building this thing we call the Corda protocol, which is the on-chain product, which is this thing that bridges those two worlds. So the Corda protocol is this you could call it a yield vault, but think of it as an application where investors can send stablecoins, so they send their money, and then through the interface they can decide which real world assets, which funds, whatever it is they want to invest in, and they don't have to have been originated on the Corda blockchain. They could be directly issued by fund managers, or our entities could go buy them, but it acts as that bridge, bringing things on chain. So far so good. We announced it at the back end of last year. The first, the soft launch will be coming in the next couple of months, and then we'll roll it out and make it more broadly accessible to users around the world. So yeah, a huge amount of work to do, but you sometimes you're onto something when you're presenting to potential users or investors or even issuers, and the question isn't sort of like, they're not sort of raising objections or rolling their eyeballs. The questions are, when will this be ready? And then the pressure you feel isn't nobody wants my product. The pressure is you can't ship it fast enough. So it's kind of a nice kind of stress.
Yeah, it's a nice problem to have, as you say.
Yeah.
And are there others doing similar stuff to R3? Richard, what else is happening in this space?
Yeah, so there's quite a few. So I mean, that's probably the other thing that makes me feel, again, this is going to sound a bit odd, but it makes me feel quite confident, is that we're not the only ones doing this. So for a lot of the time with the original Corda blockchain, it often felt like we were often called visionaries, but visionary implies early, and early is often the same as wrong, as some of the VCs sometimes say. When you don't have a huge number of competitors, you probably should be worrying. Whereas here, we have two advantages, which is one, the Solana blockchain is, if you like, you can think of it as a fast follower, the granddaddy of the programmable blockchains, as all your viewers and listeners will know, is Ethereum. And then several years later, Solana came out with a different architecture. It was faster, lower latency, cheaper. It works slightly differently. So it was able to sort of learn from the experiences of the Ethereum community. But what people, I think, have missed is that the next layer up, the applications and the products, they also typically lag, or they have lags typically on Solana. So if I look at what's happened on Ethereum, there are some, and that's where real world assets were first issued. There's now a lot on Solana, but they're still fairly disparate. There are money market funds, there are one or two private credit funds, and there's like tokenized stocks and things. But right now, none of them have quite, and I hope we can, none of them have quite nailed this is like two-sided market where you need a really good inventory. You need almost like whole of market. It can't just be like disparate things. There has to be a path to a whole marketplace where assets of different types from different issuers are available, and where you've got good distribution. And maybe one of my thoughts on that is, when it comes to distribution, which is what we're really, really focused on, there's almost like not a holy war, but there is I still see this. There's a big division between people who say, these things, these are real world assets, they're probably securities. And so you just have to accept that securities regulation applies, and you've just got to get with the program, just understand how those laws work and deal with it. Or you somehow wave your hands and say, oh no, I've come up with some sort of magic box that means I can pretend they're not. And I think we still see that in the market. There are some super cool products from a technical and sort of like, I guess marketing perspective that have got broad distribution, they're true DeFi, anyone can invest in them. But you dig under the surface and you think, well, actually from an investor protection perspective, what are they actually buying? And then from a risk perspective, yeah, I don't know. I mean, I wouldn't want to name any of them, but there are some where
I only say Polymarket just to interject, not to point a finger at them at all, but they were operating in a space where it wasn't clear, and then they kind of there was a stoush with the CFTC, which I think has been cleared up. But I think that there was maybe ambiguity, but they were operating in many countries as well, and they got broad adoption with a lack of regulatory clarity at the very least.
Yeah, that's a really fair point. And I guess, I think you probably nailed it there by saying, there's clearly a path. There is clearly a growth strategy where you say, you know what, we'll operate in the gray area, and then hopefully regulation will catch up. So that's probably it's a more positive way of describing some of the approaches. But then the reality is, we as a firm and individuals have been around for a long time. We're all known, and so our freedom to take some of those risks is probably less than others. And so we said, no, let's not fool ourselves. Yeah, exactly. So let's do this. Let's do this properly, acknowledging that it means that there are probably some markets we can't initially issue into or distribute into, and we'll iterate from there. And then again, I'll pause up. Then raises the question of, okay, well, if you're issuing tokens, real world asset tokens that are in some way regulated or constrained, how do you make them interoperable with DeFi, which is something we're working hard on as well.
There's an appetite for investing within the crypto ecosystem of traditional assets and not to lock those out. And that's because perhaps people operating in Web3 have accumulated wealth and they would like to get exposure and they don't want to take it out of the ecosystem, one point. And the second point I think you made is that they can collateralize those assets and repurpose them in the ecosystem in a way that is more seamless than elsewhere. And what you're doing is bringing real world assets on, and it's going well so far. And the kind of pulse and the signal that you've got around that is that people are asking, when is it coming, as opposed to why are you doing this? And it sounds like Solana's doing quite a lot in that space with a more superior blockchain from a few perspectives than, say, Ethereum. But you did make a point, which I wanted just to ask further on, that you thought that the applications built on Solana in this regard are lagging a bit.
What I was trying to say was because Ethereum started earlier, things like lending markets came first. So Aave came before Camino, for example. So not only did Solana have the ability to look at previous models and think how could we do it differently or better. So did some of the core infrastructure applications like the decentralized exchanges or the lending markets. They could look at what had happened before and try and leapfrog to the next generation. So I was saying that we kind of get the benefit twofold, a more modern architecture and second generation apps. And it also means specifically for us looking at bringing real world assets on chain, we can not only look at competitors of whom we have some on Solana, but we can also look at those who are on Ethereum and elsewhere. So that was kind of my point.
Gotcha. And so what you're really saying about that is that Ethereum's got a bit of first mover advantage and more value and progress, and Solana's in more catch-up mode, and that kind of explains why, notwithstanding the fact that the tech is superior in many respects. They haven't got as much penetration into the market yet.
It explains. I mean, yeah, I think that's fair. And then you look at the relative. So you can look at absolute values, and then you can look at relative growth rates. And the bet we made when we aligned ourselves completely to Solana was, okay, on some metrics, number of value of real world assets, or value of stablecoins. I think Solana behind. But when we made our bet on Solana, I think the amount of real world assets on Solana was behind, but the growth rates were faster. And I think the lines have just crossed. So I think for RWAs, I think Solana is now number one. So it's almost like the absolute position doesn't matter. It's actually the growth rate, and the growth rate on Solana.
Yeah, the growth story. I mean, you mentioned the amount of assets that exist out there, like stable coins. I think there's about $300 billion worth, and they're earning zero yield largely. That's more like perhaps a product gap than a crypto problem. But I think the reason that the capital sits idle isn't necessarily ignorance. It's that the yield products available don't meet the risk tolerance or compliance requirements of the holders. When you look at that, what do you think is actually missing in the market today?
I mean, I think you're completely right. So, clearly, of those 300 billion, it's not. I think they're not all sitting idle, of course, because a lot of it's being deployed into lending markets and so forth. So, there are ways for people to get yield, of course. But you're right. There are some people who are just holding them, getting none, or who would like a higher quality yield. And I think. And again, this is a testable hypothesis, but as we speak to a lot of allocators, so the allocator being the term for anyone who's got cash to deploy, whether they're sort of retail or institutional or whatever. When we speak to them, what we quickly realize is that their expectations are different. This is a different category of investor to what you might be used to in the traditional ecosystem, in the traditional financial system. So first thing is, I'm going to use broad brushes because everybody's different, but we think that their risk appetite is higher. So that, clearly, if you're going to risk money on these platforms, there are things that could go wrong. So these are early adopters, fast followers, and there's a higher risk appetite. There's also, if you like, the notion of what the risk-free rate is higher. So if you think about the risk-free rate in TradFi, it's probably the rate on government bonds or whatever it is, 3-4% or whatever. Whereas if you can take Sol and stake it and get 6, 7, 8% or whatever it is, that's probably that's like the lowest risk asset you could have that's yielding on chain. And so the bar you have to reach for an interesting yield is necessarily higher. Of course, there's also risk embedded in that.
Mm-hmm.
But I think it goes a bit further, which is if I go back to the user experience, if you're on DeFi, every token, if you like, works the same. Pretty with some exceptions. They're not all. The value is expressed through the price. So even if there's an underlying yield or cash flow, it's typically experienced by the price going up rather than there being like extra cash flows to worry about. You can enter and exit the positions very easily, so you don't have to there's not like a 3-month redemption window. And they compose the assets. Like you said earlier. You can use them in lending markets or exchanges and so forth. And so part of the challenge to bring real world assets on chain, and it's why we use the word package. We're packaging off chain yield. Is it has to be structured in a way that meets people's needs. So yeah, it has to have the right yield. It has to be accessible. So maybe none of these minimum investment sizes. It has to be something that you can buy or sell easily. So there needs to be a liquidity story. And there has to be borrowable against or lendable against. So it has to be eligible collateral on the lending pools. There's these product features you have to add, which means you might need partnerships with market makers and all the rest of it. It's not enough to say, hey, here's an asset. Would you like to buy it? You've actually got to package it in a way that understands. It's a product management problem. You've got to understand the needs of those who are the potential buyers. So I think that's the challenge we have to address.
Gotcha. I mean, I've seen social wallets have a big growth spurt, and there's this kind of integration phenomena that you're seeing there. And is there any interaction between what you're doing and the social wallet kind of movement? Or is it just more analogous in this integration piece?
I'm not sure, to be honest. I probably haven't studied that deeply enough to give a view. I mean, if I think about my short-term target investor, it's an individual or an institution who holds their cash on chain in a phantom wallet or at a custodian. That we know that's not the end state. That market is large, it's growing, but it's never going to be the whole world. So we have to think about other distribution paths. But that's you probably pushed me to the edge of my thinking on that regard now. So I need to go do more homework.
No, I'll send you an article that I read on the Galaxy website about it this week, and it was really looking at meme coins and how they monetize virality and prediction markets. They monetize informational edges, and perpetual futures allow more directional leverage, conviction on any asset. And then basically together these, 3 primitives represent, the most direct ways to, for internet native individuals to express any and profit from an edge. And the social wallet concept is bringing in what are the whales doing in this? What's happening in social media on that topic onto one surface. And there's a social wallet called FOMO, which is really collapsing the discovery, execution, and identity into a single surface for a user. And so instead of them having to context switch and go to different places to get that information, it's really about it being integrated. And I think since they launched at the beginning of last year, they've onboarded FOMO's onboarded 400,000 users, and they've basically facilitated about $2.5 billion in cumulative trading volume. So it's still nascent, but it's quite interesting to see what is happening in that space.
Yeah, 100%. That's a great description of what they're doing. Thank you. And it triggers one other thought in me, which is, because I get asked sometimes, well, how is what we're doing different to perps, or why aren't we building a perps exchange, or even the prediction markets? And I think the thing we're bringing, or if you like, the thing the real world asset movement is bringing is I guess it's in the title. It is cash flows emanating from the real world. So if I look at, I guess whether it's a perps exchange or or a prediction market, they're inherently zero sum. If you like, the winnings on that platform are funded from the other side, but there's no exogenous source of cash. Whereas the thing that really excites me about real world assets is no, there are real cash flows in the real world it's not, it's not closed loop, if you like. There's something exogenous to it which is unique to RWA. So I'm not saying it's better. I'm just saying it's a difference.
That I think explains further why you expanded your strategy was that the addressable market and the obtainable market it's like an ongoing income stream, which means that market is large and growing and continuous.
Yeah, that's a fair point. I'd agree with that. Yeah.
When you bring like traditional assets on chain, they would presumably bring like legal, regulatory, and you're laughing already. That's called cosmic laughter. And constraints that don't exist in like pure crypto markets. Like, what are the biggest design challenges when you bridge these two worlds together?
I mean, welcome to the pain in my world, because you're quite right. So let's take the if you like the worst example. So imagine you're in a jurisdiction where the asset is regulated as a security. So you think about the first thing you do. So you've got the Corda website. We're offering the opportunity for investors to buy something in our yield vault. Well, if you're in a jurisdiction with strict securities rules, first of all, at the very minimum, you need to know who they are. So they can't. So anonymity is out of the window. You actually need to you need to know your customer. You may in some maybe all instances need to know the source of funds. There might did the money come from was there a sanctioned entity involved? Got to worry about money laundering. So primary issuance and also redemption when they want to sell back to you. There's clearly some gatekeeping you have to do because you're bridging, if you like, from the real world to the DeFi world. But then the interesting thing arrives, which is, well, what ongoing obligation do you have? And depending on the territory, depending on the opinion, those tokens can, in many cases, and this is surprising to some people, they can actually move around permissionlessly. And I suppose it shouldn't be too much of a surprise because that's what happens with stablecoins. If you want to buy stablecoins direct from Circle, one, you have to buy in very large amounts, and two, they need to know who you are. And similarly, if you want to redeem to them, that you need to. So issuance and redemption is a primary place where enforcement happens. But secondary permissionlessness is both desirable, I think, by many and is achievable. But of course that's not enough because your question, I think, was the right one, which is okay. Well, then, but how do you then interoperate? So to just take a worked example, let's imagine I've got a real world asset that maybe I've bought it directly or I bought it permissionlessly from somebody else. It represents some fund. I'd like to borrow against it. Okay, fine. So I go to a lending pool, go to a lending protocol, and I say, right, I'd like to pledge this asset, and I'd like to borrow, 80% of the value as cash, whatever it might be. Okay, great. Let's imagine that worked just as I've said. Fine. But now I fail to pay back the money, so that asset gets seized. Well, seized by whom? Do they have the right to redeem it? Does it go to the lender? Well, the lender doesn't want it. So who takes it? Is it the protocol? Well, can the protocol be KYC'd? So the role of a liquidator, supported by a liquidation provider, then comes in, which is there's got to be somebody who stands ready to take ownership of that and then work out the asset to maturity or to sell it. And they're going to have to be a permissioned entity. So you end up with this. It's almost like there isn't a clean boundary between like the permissioned and the permissionless world. It's actually quite an interlocking thing where for specific things like liquidity here, liquidation here, collateral here, that you have to analyze each one. I guess the trick is to bring it all together. It's endlessly fascinating. They're the things we're working through right now prior to launch.
I think fascinating is like a code word for headache.
Well, this is the problem I have because our exec chairman sometimes like he jokes at me about this because I'm a geek. My background is mathematics, computer science, engineering. I'm a CTO, and now I'm CEO. I'm running this business. But my sort of like my geeky technical, I guess, like introvert side loves this kind of thing. But I have to remind myself, I'm not the product or tech guy now. I'm supposed to be running this. I'm supposed to be the evangelist for it. So I probably shouldn't be spending my time sort of poring over legal analyses as interesting as I find.
Oh, you're allowed to have hobbies, Richard. It's okay.
Yeah.
Um, so if Corda like becomes a place where like multiple institutions can bring their like tokenized assets to Solana, how do you think about which assets are like most appropriate for that ecosystem? Like what the market's going to want? Because there's so many, but how do you choose them?
There's so much in that short question, isn't there? Because there's like appropriate implies I guess it implies like a value judgment, and then there's the concept of choice. So if I think about the long term view, the long term vision, because I've not outlined the whole thing yet, is well, it is, but it's also like who chooses. So I've talked about this marketplace where there's a range of assets expressed through vaults that then investors can purchase in. But the question is, where did these vaults come from? And of course, there's another role, there's another opportunity in this market, which is what they call the curator, which is like you might call them like an investment manager in the old world, where these are like individuals or institutions who understand what a particular segment of the market might want to invest in, and then understand which combination of which real world assets can I assemble to meet their needs, whether it's a particular risk profile, exposure to a theme, or whatever it is, and then manage that or source the assets. And so the end state vision has it's not R3 or the Corda protocol like choosing these assets. We're providing a venue where we're good high quality curators can, if you like, compete or differentiate to serve their customers' needs. Because we're not qualified risk managers or asset managers, and I wouldn't want to purport to the market that we are. Yeah.
Yeah, so I mean, that's a good lead into my next question, which is that, we're starting to see large asset managers explore like tokenized funds and real world assets directly, on public chains. Like, how do you see the role of companies like R3 evolving as the landscape grows? Is it what you just described, the status quo, or could you see yourself developing a business that actually does that and provides that service as well?
Yeah, so we're not looking to get into direct tokenization. So if I think about a major investment manager, let's take BlackRock for example. So there's the Biddle product, and they worked with a tokenizer to bring that on chain. That market is well served. There's very high quality good companies, Centrifuge, Securitize, Alpha Ledger, others who with whom we've got great relationships. So we're not seeking to compete with them. We think the thing that the market really needs is high quality distribution. So regardless of whether these assets are sourced, whether we source them ourselves or through the tokenizers or directly by the issuers, you think about it from the perspective of the allocator, the investor. You've just got this. I call it the mustard problem. You go to one of the high quality supermarkets, and there's like 30 different types of mustard. Which one do you buy? It's just like it's just the amount of choice is overwhelming. So having like a marketplace where you've got if you like, you've got proxies for those who've made choices for you, whether it's us in the early days or the curators. So you go there and know that like the world's assets are available, but you don't have to study all of them, because provided you trust this curator, it may not be the world's best private credit fund, let's say, or the world's best commodities fund, but you know what? It's like the Amazon basics. Like it's going to be good enough, and you can get on with your life. You don't have to spend 3 months researching it. Just, you go to Aldi or Lidl, it's not going to be the best mustard, but it will be fine. You don't have to spend like 2 hours deciding on your favorite mustard. So I think there's an insight there, which is, it can't be a free for all where every single product is there. It's like part of it is going to be curation in the generic sense, so that there's just not this tyranny of choice. I think the winning distributor will have solved all the legal and technical problems, but they'll also be trusted as come here and there's a good range that doesn't overwhelm you.
Yeah, I mean, I think that you're right about that. And you see that like in the supermarket and restaurants where, there's a, massive menu and it's actually not serviced to you. And you're not going to die in a ditch over like, mustard. But investments are a little bit different in that you want to make good decisions. And I mean, one of the things that the social wallet commentary gave was actually, people like using whales as a proxy of what to invest in is actually not necessarily that what they're saying they're investing is what's actually going on.
Mm-hmm.
These kind of proxies or shorthand or like people that have curated things, they might have vested interests. They might get better fees from certain things. So I think that's going to be a very interesting space to see like what we end up with product wise and what's the driver behind it. Is it like the larger organizations that, get to decide, or is there more kind of decentralized kind of approach, but still some curation and decided by who, I think is your point.
Yeah, it's a great point. I guess the real world asset market hasn't been through a calamity. It hasn't been through a situation where it turns out one of the curators was not who they purported. There's like you can almost imagine some of the bad things that could happen if we're not careful, and some of them may well do. But if I look at, my team did an analysis for me a few weeks ago about what's the present state of real world asset adoption across the various chains. So you look at, and the interesting thing to me was there's clearly product market fit for single name stocks. So you look at the amazing work X stocks are doing, and I guess because you can get access to like OpenAI or Tesla, there's clearly because it's there's demand for that on chain. But if I look at the funds that people are investing in, there are some that are doing okay with brand name fund managers, but the ones that really seem to be getting broad distribution rather than just a small number of allocators are DeFi native brands. You look at what Figure's doing and Hastra and all the stuff coming from that group. That's not really, or even like Onray. I could name a few of them. Got no view on on the quality or who they're suitable for, but brand new brands that were created and have carved out a niche for themselves on chain and are not just a heritage brand trading on the past. That there does seem to be something that the market does seem to be telling us something about like who people trust or who they choose to invest in.
Yeah, so there are insights about like what preferences are from a product perspective, or like the kind of assets that people in Web3 are more inclined to also want exposure to.
Yeah, I think so. I think and I guess we need to be aware of this as well because our brand, sort of crosses both worlds. But if I'm going to be consistent about what I said earlier, which is there's a large and growing pool of people who want to stay on chain because they think it's better, it doesn't follow that brands that were successful or well regarded in the old world would be attractive to them. In fact, there's a possibility that those assets would actually be actively repellent. Those brands would be actively repellent.
Sure.
So there is something we need to think about that.
Yeah, I mean, there might be more, like from an investment thesis perspective, the kind of MO of people within Web3 might be distinct from mainstream investors, I think is what you're saying, and that rings true. I mean, looking at like what you're doing is, allowing people in the Web3 space to get exposure to TradFi. If you look at like digital asset treasuries or DATs, that's kind of doing the inverse, allowing people in TradFi to get exposure to crypto. How do you think like this phenomena is like? Is this like kind of the phenomena you're seeing with DATs? Would you say that's intimately linked with what you're seeing with RWAs? Like, and maybe that could be even bigger because there's more money on the TradFi side of things to bring into the Web3 space.
Yeah, the DAT thing, really, I thought I understood DATs a year or so ago. So I thought, okay, fine. So I've got, there's a pool of people who would like exposure to crypto, but for various reasons don't or won't or can't directly invest. So we'll set up a company, or we'll reverse into a company that can hold it, and then in a public company, and then buy shares in that company. And then it was discovered. Okay, great. It turns out for some reason, we can argue about why that might be. Typically, the equity traded for more than the value of the assets on the balance sheet. Okay, great. That's a nice magic trick, and a lot of people rode that wave. And then and that trick worked for a while, and now for many of them it stopped working. But then you hear DAT 2.0, and this is the bit that I didn't quite get was, okay, so with DAT 2.0, what if rather than just rather than just holding the crypto, what happens if it was tied to an operating business that was aligned, or what if it was used and deployed to get a higher yield? And you think, well, actually, maybe this is your point. These things come together, because if you've got a company that holds a whole bunch of crypto, well, why can't it invest it? It needs to invest it in a relatively predictable and risk managed way. Well, why not invest it in real world assets? So the circle is complete. I think I've not thought enough about it, but I think there's a logic to that. Yeah. But I have to admit, I've always struggled with the DAT concept, because given that I personally can buy crypto directly, why would I buy it for a premium on the stock market? That always confused me.
Yeah, I mean, I think that the difference between, say, like an ETF with crypto as the underlying and a DAT is you've got this financial engineering piece, and the delta between the NAV and the share price, which kind of has more, there's more like financial structuring inside the company, and then there's more kind of whether you want to buy and sell the stock, not just because of your view on the underlying, but also the delta between the fund NAV and stock price. So it kind of has options attached to it, as opposed to like an ETF that, is just representing the underlying. And
Yeah.
maybe that spiciness is what brings you some more discomfort.
I think you could be right, and also there've been a couple of things in our conversation that I found it's been super useful. Only not only in that, but specifically because I've realized over the last few months, when you're so heads down building, you think actually every so often you do need to put your head up and just remind yourself about the broader space. That's something that there's obviously been a lot of negativity about them recently, but they're not going away. Some key insights at the heart of them. So you're right to ask that question.
Yeah, so with you're working with like large financial institutions adopting blockchain technology. What are your observations about what's happening in the space around that? Like, there was a time, you've been around a while, and you said that the way you would have described R3 would have been different, 2, 5, or 10 years ago. So, you're an OG. Could you tell us a little bit about what it's like now, and maybe frame that in the context of the kind of change in sentiment that you've seen?
Yeah, so 10 years ago, I guess over 10 years ago now, when R3 was founded and when we were getting going, or even 11, 12, 13, 14, 15, maybe even when I was doing this at IBM, there was this dynamic that just made it so hard, because those of us who'd looked at Bitcoin as it was only then, it was so obvious to see this is so obviously going to be a big part of the financial future. And whether it was Bitcoin or, as the meme was back then, or the technology it runs on, it was clear it was going to have transformational impact. But the reality was there was just no way for regulated financial institutions to engage with it. Though I used to joke that we'd be in meetings with banks, either when I was at IBM or at R3. If somebody said Bitcoin, the compliance team would jump out from behind the plant and arrest them all. It was just like it was a scary time. And so
Yeah.
the question we said was, well, we could just wait until it's possible, or we could find other ways to progress. So that's why we built the Corda blockchain. It was like, how can we take some of the insights, some of the benefits this technology provides about a single shared computer, replication and consensus, and can we start to help modernize the financial system? And that's what we did with Corda, and that's what led to our dozens of networks. But these things were not connected to crypto. They were inspired by it, and they were perhaps on a path towards it, but they were not giving the banks direct exposure to it because they couldn't. Fast forward now, when we're recording this, it's half the tales of the SEC advice on what types of tokens are securities and which are not. There are banks now running custody businesses. There's like the fear of crypto is no longer there for banks. And so when someone says to me, "Well, what should banks be doing?" I say, "Well, it's just a business now. If you're in the custody business, why aren't you offering a crypto custody business? If you're in the trading business, why aren't you trading crypto?" It's not like we should run an innovation program or we should have an innovation team. There's a market there that either you just need to make a strategic decision, should we be playing in it, and if so, where? It's the execution is hard part, but there's nobody. I don't think there's anybody asking what should we be doing. It's pretty obvious what they should be doing. I think depending on their business model and where they are in the world. I think
Dipping their toes in.
yeah. Well, they should. If they're only dipping their toes in, then almost certainly I think they're behind their competitors.
Yeah, I would agree. What would you say, is the goalpost for you for this year? Where would you like to be at the end of 2026?
So the in terms of like what we need to have got done by this year is we have to have delivered our soft launch, which is when we roll this out to a small number of large allocators to test the pipes, make sure it works, make sure the assets we're bringing to market work, and then rolling it out around the world to countries where it's eligible. I don't know whether we'll get there this year, but I'd love to have the curator path open so that it's not just us bringing these assets to market. But if this time next year people are talking about the Corda protocol R3 as a mainstay or as sort of like as the leader of RWA distribution on Solana, well, I'll be pretty happy.
I mean, given you've just delivered something ahead of schedule, it's possible you could do it again.
Exactly. So lightning could strike twice.
Yes, in the same place. Richard, what are you listening to music-wise at the moment? Like favorite song?
Oh wow, that is putting me on the spot there. This is actually going to be super obscure. Just telling truthfully, just looking at what is on my Spotify and Sonos. There's a '90s indie band called Manson in the UK, Mansun. I just found, I don't know how it came up, but I just went back and started listening to some of their early albums, and completely obscure. I don't think anyone outside Northwest England's probably even heard of them, but listening to that. But the other thing I started doing, and this is just how you can go down the rabbit hole, is and I'm going to be really annoyed now because I can't remember the guy's name, but there's a guy on YouTube who just records himself. His fans send him the names of albums he's never heard of, and then you just watch him listening to it. It's kind of like a response channel. But watching it's kind of like the thing I like about it is it's kind of semi-voyeuristic. Is you dig out albums that you love yourself, which you remember from your teens or from your past, and then watching somebody who's a music lover discover them for the first time in real time and seeing how they respond. There's something quite good about actually just seeing somebody discover music that you liked. So it's a great YouTube channel. I just wish I could remember his name.
Sounds like nostalgia meets voyeurism.
Yeah.
So cool. Thanks for sharing that, Richard. And it's really been a pleasure to talk with you. Thank you so much for taking the time to chat, and look forward to following your launch and your early deployment of your tech.
Appreciate that, Gemma. Thanks so much. So this has been great. Thank you.
That was Richard Brown, CEO of R3, on why distribution is the real problem in RWA and why the financial system has to come to on-chain investors, not the other way around. If this gave you something to think about, share it with someone who needs to hear it. See you next time on Unblocked.